The Bank of England is drafting a new regulatory regime to govern sterling-denominated systemic stablecoins. Because London remains a primary global financial center, the standards established here will likely set a lasting precedent for regulatory frameworks across the world. The UK is entering a crowded landscape. While the European Union has already finalized the MiCA framework and the US debates the Genius Act, the bank's proposal takes a noticeably more restrictive path. The bank is operating under a core mandate: absolute financial stability. Their primary objective is to eliminate the risk of a digital bank run before it can even begin. However, the financial industry has raised a technical alarm. In a formal response, the Institute of International Finance argued the bank's current trajectory is flawed. They suggest that by over-optimizing for total stability, the bank makes issuing a stablecoin commercially unviable for most businesses. Traditional banking tools are poorly suited for programmable money. The tension between security and utility rests on three specific pillars of the bank's new proposal. The first pillar is backing assets. To secure the currency, the bank mandates that every coin be backed by the safest, most liquid assets in existence. The proposed 60-40 model requires holding 60% in short-term UK gilts and 40% as unremunerated Bank of England deposits. In a high interest rate environment, locking up half an issuer's capital at zero yield creates a massive opportunity cost. When an issuer cannot earn a return on 40% of their assets, the commercial incentive to maintain a systemic stablecoin disappears. This also poses a risk to the wider economy. If users pull their money from commercial bank accounts to buy stablecoins, and that capital is then locked in a central bank vault, the commercial banking sector loses a vital source of funding. This drain on deposits reduces the banking system's capacity for credit creation, making it more expensive for individuals and businesses to get loans. Then there is the second half of the mandate, the 60% requirement for short-term gilts. The IIF points to a physical supply constraint. The total market for short-term UK government debt is estimated at only about £100 billion. Forcing massive systemic stablecoins to buy 60% of their backing from this specific pool would create significant sovereign debt market distortions. This contrasts with the US and EU frameworks, which permit backing through diversified money market funds and interest-bearing commercial bank deposits to avoid these exact bottlenecks. While 100% risk-free backing effectively neutralizes the threat of a run, it simultaneously removes the commercial reason to exist and threatens market liquidity. The second pillar involves capital reserves and prudential calibration, the emergency buffers an issuer must maintain. The bank proposes a higher of rule for these reserves. An issuer must hold capital equal to either 6 months of their total operating expenses or the cost of recovering from their largest plausible loss event. Operating expenses, or OPEX, include the total cost of running the entire institutional entity. This formula creates a massive disparity. Because the calculation uses the entire firm's operating expenses, a large diversified institution is forced to hold enormous capital compared to a dedicated startup, even if its stablecoin division is tiny. This creates a structural imbalance, effectively penalizing established financial institutions while favoring bank-only subsidiaries. The IIF agrees with the bank on one crucial safeguard: holding backing assets and reserves in a statutory trust, ring-fenced from the issuer's insolvency estate. This legal structure ensures that if the issuer fails, coin holders can redeem their funds at full par value immediately, without waiting for a lengthy liquidation of the firm's other assets. But the underlying problem remains. Blunt prudential rules like the OPEX formula create barriers that prevent diversified financial institutions from safely entering the market. The final pillar is holding limits, a tool specifically designed to keep too much commercial bank capital from flowing into digital currencies too quickly. The bank has proposed two static caps, a £20,000 limit for individuals and a £10 million limit for corporations. However, these caps are being applied to permissionless blockchains, where users typically operate through unhosted, pseudonymous wallets. The IIF notes a direct technical conflict. Per-user banking limits cannot be mapped onto a decentralized architecture, where user identity remains unknown until the point of redemption. On a decentralized network, a user can easily bypass the £20,000 cap by using a Sybil strategy, simply spreading a £100,000 holding across 5 separate unlinked wallets. Truly enforcing these limits would require a global, horizontal data sharing protocol between every custodian and exchange, infrastructure that does not currently exist. The problem is mirrored in the corporate limit and the structural arbitrage it encourages. A £10 million corporate cap incentivizes individuals to incorporate shell companies just to bypass the much lower retail restriction. Meanwhile, the £10 million cap itself is often too small for legitimate business operations like treasury management or institutional settlement, which move billions. Static holding limits on dynamic, permissionless networks are technically unenforceable. They encourage regulatory evasion while simultaneously blocking legitimate institutional use cases. Unremunerated reserves, skewed capital models, and unenforceable holding limits create a compounding friction. The IIF's ultimate warning is that importing traditional banking constraints into the digital asset space creates a fundamental mismatch with the technology. If the UK persists with these rules, it risks becoming an uncompetitive outlier, triggering a rapid flight of capital toward the US and European markets. Users seeking utility and yield will simply migrate to US dollar or euro-denominated stablecoins, operating under more flexible regimes. By over-regulating sterling stablecoins, the UK risks ceding its market to non-sterling competitors that operate within its own borders but outside its direct monetary control. This widespread dollarization would result in the exact opposite of the bank's goal, eroding its ability to maintain domestic monetary stability. The IIF suggests a more adaptive path, utilizing dynamic issuer-level flow metrics and emergency gating powers rather than rigid static caps. For stablecoins to work, regulators must move beyond analog restrictions. Only by accepting the realities of decentralized architecture can they safely integrate programmable money into the global financial system.